Welcome to our channel, Clear Value Tax. My name is Brian Kim. I'm a certified public accountant and one of the partners at our tax practice. Today we're going to be discussing how to minimize your audit risk. We're going to identify the audit triggers and the red flags. This video is really catered for the self-employed people, so this is sole proprietorships, single member LLCs, but it's also applicable to business owners, those who are reporting on the 1120S, which is the S Corp, 1065s, which are partnerships, and the 1120s, which are C Corps. So, some of these pieces of information and advice might seem blatantly obvious. However, I feel like I need to say it because I see clients bringing these types of returns in all the time that get audited, and it's clearly identifiable what caused the audit to occur in the first place. So, I want to put in a disclaimer here that I'm not referring to my clients, I'm referring to the people who get audited and then come to me. Well, I guess technically they do become my clients, but these are people that I did not work on. They went to a different accountant or self-prepared, they made a mess, and they're coming to me to fix it. So this is what I see from my experience, and I just want to share them with you. Okay, the first one, it's not to use clean figures for your expenses when you're trying to deduct them. So what does that mean? That means if you are trying to deduct, let's say your cell phone. If you write cell phone expense, $1,000, supplies expense, $2,000, travel expense, $5,000, it becomes blatantly obvious that it's just made up. I mean, there's a very improbable probability that the numbers just happen to break out like that. It's just a coincidence. However, in most cases, it's clearly obvious that it's just a lie. So if you're just going to consistently use clean figures like that, it's an audit risk. So the tax returns that you file, they're just going to run through a scanner, and then the IRS algorithms, when they're deciding who to audit, they're gonna look out for that. And that's a scenario where it just looks fishy. Like, if that's not obvious to you, please be aware of that. So please don't do that. I mean, it's ridiculous. However, I do see that happen all the time. Another one which is quite obvious is when you make your profit break even to exactly zero. So what that means is, okay, you have your sales, your revenue, and then you have your expenses, your deductions. And when you have your sales and your deductions equal exactly out to zero, that looks fishy. Please be cautious. And again, perhaps that really did occur. But just know, even if that really did occur, that's an audit risk. So just be wary of that. Okay, another one are the expense categories themselves. So some will be questioned harder than others. For example, meals. I can't give you a dollar figure that I'm going to say that is a red flag because it's in relation to your sales. It's in relation to your revenue. So what does that mean? So if you tell me, or if you ask me, does $20,000 in meals sound too high? Is that a red flag? The answer is, with just that variable, that gross value, I can't give you a yes or no. So let's say your sales are $50,000, then if you tell me $20,000 in meals, yes, that sounds very high, and that would be an audit risk. However, if you tell me that your sales are $800,000, then $20,000 in meals, now that does not sound high at all. If you tell me it's $3 million in sales, then $20,000 in meals, then actually that sounds quite low. So it really depends in relation to your sales. Okay, so another area that would get more scrutiny is mileage. So you know how when you're filling out the business activity code on Schedule C, okay, they know what field you're in. So let's just say you want to claim 20,000 miles. If you want to claim 20,000 miles, does that seem high? Yes or no? I wouldn't know. I need to know what field you're in. If you're in sales, or if you're a broker, like a real estate agent, then 20,000 in miles does not seem high. However, if you are a bookkeeper and you tell me 20,000 miles, yes, that seems very high. So it just depends. So certain answers, it just depends. It just depends on, what your profession is, what your field is. It depends in relation to your income, to your sales. So it just depends on those variables as well. So please take that into consideration. Another area, another expense that is more scrutinized is the home office deduction. So perhaps you're going to claim you're supposed to take the square footage and whatever you use exclusively for business divided by the square footage of your home, then that's your business use percentage. There's other ways to do it. There's the other methods such as by rooms and whatnot. However, basically it's going by proportion to your home. So if you're going to claim something like 30% or even 40%, you're really pushing the boundaries. So just know that, okay, if you really are utilizing it exclusively for business, 30%, 40%, or even 20%, I mean, that's on the higher end, but just be aware of that you might be challenged. That's an audit trigger. So be careful when you're using the home office deduction as well. However, if you truly are using the home office as your exclusive place of business, then you are entitled to use that, so absolutely take it. I would encourage you to take it. However, just be aware that yes, using a higher percentage as your square footage for exclusive use of business does increase your audit risk. Just be aware of that. Okay, so in addition to these items that would be on the Schedule C, you're also going to have your ordinary tax forms as well, because perhaps you'll have investment income, you'll have stock sales, you'll have interest income. Perhaps you'll have W-2Gs, things like that. Just know that if you receive that tax form, then so did the IRS. So if you don't report that, they're going to say this taxpayer received this income on this tax form, and it's in our system, but they didn't report it. If you don't report that, they're going to clearly know. That's going to be a IRS letter for sure. If the amounts are not insignificant, so it'll be an IRS letter for sure, and it could potentially lead to an audit as well. I'm not trying to scare you, but however, this is what happens. So if you get an IRS form, obviously, please report it. Okay, so those are some pieces of information, some pieces of advice. We hope that helps. If you found this useful, please feel free to give us a like or a share. We'd highly appreciate that. And we will make more videos that we find are very applicable and useful to your lives, as business owners, as taxpayers, and how to reduce your taxable income. So thanks for tuning in. We look forward to seeing you next time. Take care.